Senior. All right. So we're looking at efficiency ratios, and it's just mostly a reverse of the working capital or the other part of the liquidity we looked at. So they are very interesting ratios, and this mostly looks at how many times. But then let's introduce these ratios briefly so that we can understand what they talk about. They are known as activity ratios also. So where you see efficiency or activity, they are both synonyms in computation of ratios. They are financial metrics that assess how effectively company use assets and manage operations to generate revenue. So the target is your assets, your long-term investments, how you're able to use them. So we are measuring how much asset you use to generate returns. Very important. So assets are the target, and the measurement of how much management are operating well to generate revenue and returns for those that have invested their wealth in the venture or in the business. This ratio measure the efficiency of key activities such as inventory management, asset utilization, accounts receivables, and others. They are important for determining how well a company is managing its resources, optimizing costs, and managing profitability. So it's very important because they measure how efficiently management is working. And if there is no measurement, management will not be able to, the owners of the business will not be able to manage or measure management to see how much they are generating returns on their investment. So these ratios help optimize or maximize that, to show us how the company is managing its resources, optimizing cost, and maximizing profitability. Efficient operations typically lead to improved cash flow, of course, reduces waste, and better overall bottom line or financial performance. So efficient operations in daily activity is key in these ratios. This is very important. So investors, analysts, people that have invested their funds or their value on the company use efficiency ratios to evaluate operational effectiveness. This is very important, and identify areas of improvement. So this ratio helps us identify where the company is or the management is lagging behind, and also shows us where to improve. And a wise man said the biggest room in this world is the room for improvement. So improvement is better, and that is what we crave for daily as chartered accountants. So have a look at that short introduction. We'll look at the first ratio. Do you have any question on the introduction? If you are not clear on what efficiency or the activity ratios are all about. Okay, I believe we understand the ratio. So the first ratio we'll look at is the total assets turnover. One of the main ratios of the activity area is total assets. You are measuring the efficiency and effectiveness with which the entity's assets are used to generate sales revenue. Very simple. So your total asset, looking at your non-current and your current, those are massive investments. The non-current assets are heavy capital-intensive investments, while the short-term or the current assets are medium-sized. Some are also highly valued investments from the current assets. So maybe your machinery, property, plant, and equipment, you use them to produce inventory, pay receivables, and so on. So the current assets culminate from the fixed assets or the non-current assets, and those assets generally are the entity's assets that you use to make money or generate revenue. So the higher the total assets turnover, the more effective the company is in using the resources invested in it. So a higher turnover or ratio shows that the company is doing well in using the assets to make money or generate revenue. So this ratio can be used to measure the effectiveness of a company with the components we are going to be looking at, and the ratio is calculated as follows. Total assets, we're looking at the sales as the numerator, and the total assets as the denominator. This measures the rate at which total assets generate sales revenue. So the total assets, our investments, and we are looking at the sales it generated from the investment. It measures how efficiently the company uses, of course, we've said that, and it's a key indicator of operational efficiency. So your conversion, your ability to convert assets into sales is a key indicator of operational performance. A higher ratio signifies better asset utilization, and a lower one indicates inefficiency in using resources. Very simple. So where you see a higher ratio, as we'll be calculating with Dan Kabir, it shows the company is doing well, while a lower one is not doing well. So a ratio above 2. So let's say 2:1. That means your sales is 2 times your asset. Generally is high. Generally. So 2:1, but 1:1 just shows that the same value of asset you have is the same value of sales you made. So we look at the formula again in another way. Instead of sales, it's revenue, net revenue, maybe after other deductions of refunds and whatever it is that the revenue came with, any expense the revenue. So the net revenue divided by the average total asset. So average total asset is looking at the beginning and the end of the year. So it's a clearer picture. If you don't have maybe comparative financial statements of different years, you can just pick that particular year. But if you have different years, the average is the clearer picture. The beginning and the ending divided by 2 is better to have a perfect picture. So where your sales is your revenue, and the average total sales is the beginning, like I said, and the ending divided by 2. It also means that the revenue is generated for every naira, the dollar, every naira of assets a company owns. A higher one indicates the company is making good use of its asset. We've said that over again, wherever a lower one suggests underutilization of assets. So let's go back to the formula and not move too much, and let's calculate Dan Kabir. So you do 2021, please. You assist me with 2021, 2022, based on the formula. Sorry, were you interjecting, Julie? You're trying to say something.
No, I was trying to get the calculator.
Oh, okay, fantastic. Aisha, please, so get your calculator and let's crunch the numbers very fast.
So what formula are we calculating? Is it the total assets turnover?
Yes, total asset turnover. So we are doing total asset turnover first. You can see it on the screen. We have net revenue divided by average total assets. Exactly. Okay, so total asset turnover, let me put my sales revenue here.
Total assets.
Yes, your total assets. That's non-current and current. Exactly.
Current assets, okay. It's not average, total.
Total asset, yes. So the average is the denominator, is the component we are using. But the name of the ratio is total assets ratio. Can't call it average asset. Call it total assets.
Of course, there's nothing like average asset here, because asset is asset.
Exactly. So let me just organize my own calculator here. Okay, so you help me with 2021 and 2022. Aisha, please engage so that we can be very fast. It's a simple ratio and I love the interpretation. The interpretation is clearer than others. Okay, so I'll pick my revenue for the first year. That's the first.
78.
That was fast.
0.78.
Okay, so let me go and take your figure. So let me say my. I'm coming. Let me say what's our okay, total assets. Let me just write it down. Then I pick your figure beginning. The total assets.
0.8 both sides.
Oh, really?
0.78. 0.78. Sorry, 0.78.
Okay. And average total assets. Okay, so 0.78. 0.78.
How about 21 and 22?
Yeah.
Okay.
It's 21 and 22 I did though.
Okay, 21 and 22.
21, yeah, 21 is.
Oh, okay. Okay. So let me get my beginning and ending. You guys are very fast and I love that. So let me
That's
get
what
my
you said we
beginning.
should do.
Yes, so I was speaking and I was asking you to do when me have not even done. Okay, so let me have my beginning, total assets, and ending. So let me take this and quickly do it so that I can take your figure.
Same thing. Okay, just 0.79.
Wow. Same thing with 2021.
2021 is 0.78. 2022 is 0.78, I think. Yes.
Okay. Okay. So this plus this divided by 2. How come I'm having 2 points? Is that what you have as your average? 2,875 for the first
Is it
year.
average? I don't understand. Are we doing average?
No, we did do the average.
You have to do
I thought
average.
you
You
said
look
there's
at
no
your
average.
I thought you said there's
No, there's
you
average.
said there's no average asset.
I thought you said there's no average. Average
No,
total
there's average.
assets. Okay. We asked
Yes,
you.
average total
I asked you. You said
assets.
there's no average.
So
No, there's average. There's average. Maybe I was
Because I asked
interpreting
you, you said there's no average.
No,
I
there's
didn't go
average.
with average too.
Ah,
Wait,
no, you
total
have to work
asset
with
turnover.
average.
The first formula I saw the first slide you showed us was
Yes,
sales divided by total assets. Yes, this
total
one.
assets. Yes, so this one is the first variant. But this one is not the perfect picture of what transpired during the year. It's almost the same thing with what we've been conversing about. So this one is a perfect picture. Even though if you use this one, you may not be penalized. Your interpretation will be same close. It may be close to the answer of this one, but this is the perfect picture. This perfect picture. The average is better where you have differing years, but where you don't have different years, you have 1 year, you can just use the total asset. It's fine. So this is better. So the average is better. We use the average total asset. It is better. It's a clearer picture. Don't mind my interpretation or my
0.82.
explanation. Okay.
Oh,
0.82.
So let me get my first one first before I use the second one.
0.84.
Okay, so for which year are you computing?
2021 is 0.82. 22 is 0.84.
0.82 and 0.84. Okay, so let me see to that. So now I have total assets. I'm now saying my formula is sales revenue divided by total asset turnover. Oh, 0.61. How come I'm having 0.61?
0.88.
Is it for 2020?
Yes.
Okay, so why am I having 0.61? Let me do it again. So my sales revenue divided by my average. Is this my average correct? Can you confirm with your calculator?
It's not correct.
I want to do that.
So let me recalculate. So this plus this.
Average is supposed to be 1493625.
Okay, so this plus this.
Yours is 0.88.
Yes,
Okay.
that's my.
Okay, divided by 2. That means my formula is giving me something wrong entirely. All right. So what I'll do is I'll just add another sheet.
You didn't
here.
divide the answer by 2. Yeah.
Yeah, so I'll have this, then I'll divide the answer by 2. This divided by 2.
You didn't divide it by 2.
Yeah, so I have a clearer picture now.
Yes.
This is what I have. Yeah. So my sales revenue divided by my average. Exactly. So Aisha is correct. So I have 0.88. Exactly. Okay, so Julie, you have 0.82, 0.84.
0.84.
84. All right. 0.88 is to 1. So what it means is that for this year, we didn't even score up to 1. We scored 88% of our total assets. So we generated 88% revenue of our total assets. So since it's in times, because you measure it to see how many times. So our 2020 sales revenue is not even up to once. It doesn't even cover once, which in my view is slow. So let's validate the total asset figure for this 2 years. So our total asset will be okay, so this would be the ending, and this will be the beginning for this. So this will be the ending for 2022, and this will be the beginning for this. Okay, so let me just drag this to make it easier for us. So this is our total, and this is our average. Fantastic. So let me go get our revenue quickly. We'll just validate your figures. So this is our revenue. We have this as our exactly. So let me just drag this. Good. We are on the same page, 0.82, 0.84. So for these years, we didn't even achieve up to one of our investment. We just did 88%, 82%, and 84%. So in my view, it's low. But let's look at what it means. Let's look at what it means. The implication is that a higher total asset turnover ratio suggests the company is using its assets effectively or efficiently to generate revenue, which can be a sign of operational effectiveness. Exactly. While conversely, a lower ratio. So in this case, it's low. They didn't even break even. Let's use the word break even. That okay, they generated revenue as much as the total assets for each year. So I believe they are struggling. Management is struggling, and it shows underutilization of the assets. So 0.88 is low. Even if you use the total asset figure, you will see that it's the same thing. It will still be low. Maybe the percentages is about maybe 0.7, 0.6. If you just use the beginning or the ending without considering the average, you'll still find out it's low. It's still low. And the interpretation is that a lower ratio indicates or implies inefficiency. The company is holding excess assets or is not utilizing them to drive sales. That's what it means. So in Dan Kabir's case, the company is underperforming. That's just the bottom line. And what is the cause and effect? Okay, sorry, somebody's trying to say something. Somebody interjecting? Oh, okay. Okay, I thought somebody interjected. All right. So what are the causes of a high total asset turnover, which is always the result that management expects a high turnover ratio? A high total assets turnover ratio is caused by effective use of resources. Exactly. Optimized operations, high sales volume relative to assets base. So where you have high sales, high revenue relative to your asset base, the company is doing well, and the cost, it culminates in total assets turnover. And the effect is better profitability. Exactly. Improved asset utilization, stronger operational performance. These are the effects of a high total asset turnover above 1, 2, 3, 4 times the assets. If the results are that, I mean, it makes a lot of sense. But a lower one, for example, in Dan Kabir's case, shows or is caused by underutilization of assets, declining sales, inefficient asset management, holding excess inventory, receivables, and not even paying payables on time. So these are the causes. And the effect shows lower profitability. Like you saw, Dan Kabir's bottom line is very low, which is their net profit. Potential cash flow issues, exactly, like we saw in the liquidity ratios. And increased carrying cost for unused asset. Exactly. So when you are not using your asset, you are underutilizing them, and you carry a lot of carrying cost on those assets. So in conclusion, the turnover total asset turnover ratio is a key measure of how efficiently the company uses its asset to generate sales. A higher one reflects good asset utilization, operational efficiency, and a lower one indicates there is need for improvement. Exactly. So bank abuse management need to improve. And that's our conclusion. How should they improve? Drive more sales, produce more, push the products out, reduce your cost of sales so that you can have a positive bottom line. Very important. And this area of improvement should be shown in managing assets and driving revenue. So companies and as chartered accountants, we should strike balance between asset levels and sales generation to culminate in enhanced profitability. This is very important. So I think it's very simple enough. I don't know if we have any questions or comments. It's simple enough to see that the result of the company just shows that you are either doing well as management or not. So any question?
The total asset turnover.
Yes, I believe it's very clear. All right, so let's run to the next one, which is net assets turnover. Net assets turnover. This ratio measures how efficiently a company utilizes its net assets to generate revenue. So the question is, what is net assets? Net asset refers to your total assets minus total liabilities. Exactly. So different
Total
from
assets minus total liabilities.
Yes. Exactly.
Oh, it can't be total assets. Net assets.
Yeah. So in some other cases, you have total asset less current.
Okay,
so that
total liabilities. Okay, without equity, because net asset is equity now.
Exactly. Net asset is equity.
Equity.
So yeah, so some variations will say total asset less current, leaving the long-term liabilities. But this one looks at the total liabilities. Yes.
Okay, that's
so you want
true.
To
they remove current. Okay.
Yes, they remove current from the other one, and that's when you are calculating return on capital employed. So you're not looking at the long term, but in this one you're also looking at the long term and the short term, and that's why you're deducting the total. And this is representing the equity invested in the business. So ordinary shareholders want to know what they are generating in return based on their investment, and that's why we're looking at net assets. So the net asset refers to the total asset minus total liability. So take note of that. Julie, any further comments? I like your questions and notes. Is this okay? Okay, fantastic. Okay, so this ratio helps evaluate how well a company uses its equity or capital to generate sales. So equity is looking at your total asset less total liability. So these are the movements in when you're doing change of subject formula. So we have sales over net assets, sales over capital employed. So it relates with rules a bit. It's just that the rules looked at current assets, looks at current liabilities, and this is looking at total liabilities. And it measures the rate at which net assets or capital employed generates revenue. So the formula is like this. We'll also look at a refined formula. Total asset turnover is net sales, which is your revenue divided by your net assets, total asset less current liabilities, or your net sales divided by capital employed, your total assets less current liabilities. But the net asset is better to use your total so that you've deducted every obligation you have long-term and short-term is key.
Can you just excuse me for 1 minute? 1 minute, please.
Yes, please. Please go ahead. Go ahead, Julie. Oh, okay, maybe she wasn't talking to us. Hello, Julie, are you there? Hello, Aisha.
Yes, sir. Sorry.
I said, can you give her just 1 minute? 1 minute, sir.
Oh, okay. We should hold on.
Please, 1 minute, please.
All right.
Thank you, sir.
I really dozed off a bit.
You're welcome. Oh, Aisha, you dozed off a bit.
I see.
Oh, sorry. You must be tired.
I'm exhausted.
Oh, sorry. You had a hectic day, I guess. Well, it's one of those sacrifices. Don't worry. Once you qualify, all this will be over.
I can't wait.
Exactly. It's not easy. You have to sacrifice. ICAN exams can be challenging.
Are we computing this net sales to net asset?
Yes, but let's hold on a bit for Julie. She said we should give her 1 minute. So we'll compute this and now look at the meaning. So the formula is net sales divided by capital employed. So we're looking at net sales, which is our total revenue from sales, and our net asset is our total assets minus total liabilities, which is equivalent to shareholders' fund. Okay, so maybe we'll go ahead now. She'll join us in the next minute. Okay, so I'll calculate 2020, you'll now do 2021 and 2022. So in this case, all right, you're back.
Thank you. Yes, sir.
All
Thank
right,
you.
you're welcome. Welcome back. Yep. Okay, so we're looking at the net sales to net asset turnover ratio. So we want to calculate it with the formula we just saw on the screen. So we have it as
what
yes.
Net sales? Why is it called net sales, sir?
Okay, so net sales now, when you have your revenue, if any expense comes, like you need to refund credit notes, you need to issue out, so you deduct that. Yeah, so that's why it's net. So if there's any figures that have to do with refunds, discounts you give out, you must remove it from the revenue. So the examiner may just pimp it like that just to get you off balance. Just say there are some refunds or there are some discounts you give for early sales payments. So you need to remove it to have your net revenue, and that's what it means. Net sales.
What if there are other income from other sources apart from the business? Are we going to remove them too?
No. You can't remove them. So anything that has to do with refunds, discounts, or anything, those are close. Yes, that's what it means. Yeah. Okay, so let me pick for the first year. Based on our formula, we have it as revenue. I'll just even use the total asset revenue I used here. So let me just take this and post it here. So let me post the 3 because I'll still use it since you guys are doing 2022, 2023. So I'll post here. Then the next thing I have my net sales. So I'll still take my total assets. Take all of them, beginning and ending. And now I'll go and take my total liabilities. That's just what I'll go and look for. Let's go and take my total liabilities. So I have a total liability here. I should have total equity and liabilities exactly. So don't forget the net. The formula is not average, but total assets will do average. But here, take note, you are not doing average. Don't forget. So, yes, the formula is not giving us average because of the complexities with the total liabilities we are removing. Okay, so this is the beginning. So we use the ending. So let me just take this and use.
So it's net sales over total over net asset. I mean.
Yes, net sales over total assets. So this is it.
So net sales over. Sorry, okay?
Net sales
over net assets. Okay.
Over net assets, yes. Okay, so I have this. So let me remove my total assets. I don't even need to do beginning and ending now. So let me just remove this beginning.
It's equity, is it correct? And if you don't do the minus and plug, if you take equity, is it correct?
Equity.
If you just pick equity, is it okay? Instead of
yes, exactly. Instead of taking that net. Yeah, you are correct. So if you just take this equity, exactly. You are right. So I even want to see. Let's even test and see if it works. So total assets, we have this. Then total liabilities, we have this. Okay, I went and took total equity, so let me take total liabilities. Let me see if it culminates in. Okay, so I'm not supposed to take total equity and liabilities. I took the wrong figure. Okay, so let me say net assets will be total assets minus total liabilities. Right? Well, I'm not. Let's go back to that Kabir.
It's not
Let's go
working
back
now.
It's not working. Yes. Look at. So we have 1.0, 1.3. So the total equity is not giving us the same values. Yes. If we take the values, yes. If we take the same values.
Oh, why is this so?
I'm surprised. It must be from the question. Because the net asset is supposed to be the same as equity. So let's do something. Let's also, since we are practicing, let's also take total asset and less current liability. So let's do current liabilities. Okay. Yeah, so because the net asset is either total assets or current total asset less total liabilities, or total asset less to current liabilities. So let's take current liabilities. So current liabilities is 420, say 3 of them. Okay, so let's come here and let's post current liabilities here. Current liabilities. Okay, so this is our current liabilities. And let's use another, let's say net assets number 2. Let's see if it will culminate in this. So this is our total equity. Yes, it's good to explore. So now we have this as total asset less current liabilities.
Current liabilities.
Yes.
It's still not the same.
It's still not the same.
So
yes.
we'll just move total asset less total.
Yes. Yes, exactly. So let's use total liabilities. Exactly. It's still not giving us our total equity, all right? So something must be wrong with the question. Yes.
Somewhere.
Yes, something must be wrong with the question. Yeah.
It's never right to just take equity. Always do the minus.
Yes,
right?
Yes, it's better. It's better to do the minus, exactly. But under exam condition, if you take equity, you won't be penalized. Though. Just know that. You won't be penalized. Yes. If you take equity, you will not be penalized because it's the same result, even though the figures are different. And when we calculate it, it's just that we don't have much time. You see that the variation in percentage or the amount is not that far. It's not significant. It will almost be the same. Within the same range. So the result is not the computation is not the matter. What matters is the interpretation. That is just it. But if you get your variables correct, just post, you don't have issues. So in this case, let's use the formula. Let's ignore total equity. But if you use total equity under exam condition, I like Julie. Julie wants to be fast because time management is slow. Yes. All these shortcuts.
We should be fast.
Yeah, exactly. You need it because if you are not fast in the calculation, you will not have time to write. And the writing is very, very important. Very important. So take note of that. So if you use the shortcut, total assets less total equity, fine, you are correct. Get your result, your values, and please start interpreting. That is very, very important. Very important. So it's fine if you do that under exam condition. Okay, so let's use total asset less current liabilities. As we've tested, we have issues with the figures, but it's fine, no challenge. So let's do our total net assets.
1.78.
Okay, turnover ratio. All right, let me quickly get that. So your 1.78 is for
both 21 and 22.
Okay. So I'm trying to calculate the net asset. What's the formula again? I'm forgetting. Net sales divided by net asset. Okay. So our net asset is, so net sales is 1.32 divided by net assets. Wow. Company is doing well with this ratio. Is that what you got in 2020? 1 point.
I got 1.78
For which
for
year?
21 and 22.
Okay. 1.78. 1.78.
Actually, what do you get?
I'm getting, I don't know, 0.104.
For 2021,
Yes.
you must be getting a figure wrong.
Yes.
Julie, can you validate 2020 for me? What did you get 2020?
Okay. Let me see the total asset less total liabilities.
Exactly. Yeah, I validated your wrong. 1.78, 1.78, exactly.
Okay.
Oh, okay. I was taking total current liability.
That's it.
Yours is 1.81.
Yes, exactly.
1.81.
So. Yeah, so I'm correct. Thank you for that validation. Aisha, are you okay now? Thank you for that.
Yes, I've gotten my mistake. I was taking current liability.
Current liability. So under exam condition is also
can you interpret it, sir? What does it mean?
Yes, we are going to the meaning now. Let's just get our figures and be sure. We are moving immediately. But that meaning is very important. No matter what variables you use, whether total asset, total current liabilities, whether total equity, the meaning is the most important thing. Okay, so let's wait for Aisha. Aisha, Alpha, are we on the same page?
Yes, we are.
Okay. Can we go to the interpretation now? Julie can't wait for us to speak to the numbers. All right. Okay. So the meaning, the net asset turnover shows how many times a company can generate sales from its net asset during a period. A higher ratio suggests the company is efficiently using net assets to drive revenue, while a lower ratio indicates the company may not be fully utilizing its net asset. So net asset is looking at your asset minus liabilities, unlike the total asset. Total asset does not bring into cognizance your liabilities. And don't forget, your liabilities is what you owe, you are obliged to pay. And this, in my view, this net asset is a holistic picture of actually what the company owns. The total asset is a management ratio that shows, okay, we are measuring management performance, but this is actually what shareholders will say, okay, we have removed our total liabilities or our current liabilities. What is our money? And this is what this measures. So the net asset is a better measurement because you have exceeded your obligations or excluded your obligations. It indicates the company may not be utilizing its asset. But you see, if you look at after excluding obligations, the result is better. You can see that they did better than the result of total assets without excluding the liabilities. But here, they've excluded total, not even total current liability. The total liabilities, long-term and short-term, and they still had the better results. Their revenue almost doubled because if you approximate this, we have 2 times our net assets. Do you get that?
Yes.
So revenue covered our net asset twice. We have excluded our liabilities, and I think this is a good performance in my view. But let's keep speaking to the numbers. The implication is that a higher net asset ratio is generally favorable, exactly, as it indicates that the company is effectively using its capital. We talked about the equity to generate sales. So equity, the total assets, the asset less our total liabilities or current liabilities is the equity figure. So even if you use total equity figure, you find out the ratio is high and is favorable, indicating the company is effectively using its capital to generate sales. While a lower one, if we had 0.88, it would have been more disturbing because after you've deducted liabilities, what will the shareholders take home? The ratio shows that, man, there's nothing for shareholders, ordinary shareholders. A lower ratio indicating efficiency in utilizing the equity base or capital structure, leading to lower returns for investors, especially the owners of the business, not even external providers of capital. So in this result for Dankabe, I think the ordinary shareholders will be smiling to the bank because for the 3 consecutive years, their ratio almost doubled, which is good. Sales covered their net asset twice. So the shareholders must be happy with management. What are the cause and effects? a high net asset turnover, the causes are efficient use of equity, exactly, strong sales performance, effective management of capital and operations. Yeah, so these are the causes. And what are the effects? Higher returns for shareholders. Don't forget, in every business, higher returns for shareholders is very, very important and is key. You can provide money for debt owners, but that's at the expense of shareholders. So shareholders, the ordinary owner of business, should be the target, and they should have something to go home with. So in this case, Dan Kabir's shareholders will be happy looking at this ratio, and it shows improved profitability and better overall performance. Why a lower one is just or shows or is caused by poor asset utilization, weak sales, underutilized capital, and overinvestment in non-revenue generating assets. Exactly. So when they overinvest and buy assets that are not culminating in production or sales, I mean, what's the use of all the assets? You sell them off. And that's one of the causes of a poor net asset turnover. And the effect, reduced returns. So the effect is always hard on the shareholders because you must settle your debts first. You have removed total liabilities, which culminates in current and long-term debt. So it's the remaining that the shareholders will now be scrambling for. And the effect is also lower profitability where you have a low ratio. So in this net asset turnover ratio, if we had 0.88, is a very poor result. It will have been poor result in the case of the total asset turnover we saw. And also potential underperformance in the market. Yes, underperformance in the market is also the effect of a lower ratio. So in conclusion, the net asset turnover is an important measure of how well a company uses its asset to generate sales. The higher ratio reflects efficient capital management, exactly, and strong sales performance, while a lower ratio indicates inefficiencies that could impact profitability and shareholder return. So as chartered accountants, this is where we come in. We need to optimize asset utilization because it's our job to significantly enhance business performance and shareholder value. So shareholder value will be eroded if we don't really compute this ratio. Now, in the interpretation, this is more holistic in practice than the first one we calculated, total asset. Total asset is more of management. We've not brought into cognizance your liabilities. And that's why even if it's low, the interpretation and the effect to management may not be that hard. But excluding liabilities is very important. And looking at this result, I think Dan Kapil's management is fine. Even if we use current liabilities, I think the result will be higher. We don't have time. We'll have calculated total asset less total current liabilities and also calculate total asset less total equity. But under the exam condition, please, you don't have that time. Do one and interpret, because your writing is where the marks are. And that is what it means. Okay, so ladies, I will now say there's no gentleman on the call. This is 9:59, and this will be a perfect place to land and stop for today. I think I'm excited about today because we've closed out on liquidity, and we are in activity now. Yeah, so we have non-current asset turnover ratio, we have inventory turnover ratio, we have trade receivables turnover ratio, we have trade payables, and we have working capital management or turnover ratio. So we have 5 more to go, and I believe in the next class we should be able to cover that and close out on activity. And next week we are supposed to look at the debrief. We have